Hey folks, Frank Zorrilla here, Zor Capital, doing a quick video off the cuff in regards to the market. Martin Luther King Day, the 21st, Monday the 21st, almost 5 o'clock. So let's just take a look at what's happening. This is the S&P 500. You know, how quickly time goes by and how quickly things change. We went, for the most part, from a market that couldn't catch a bid to a market that can't find any offers. If you remember back in December, world's coming to an end. Market is down, whatever it is, 8 days in a row in December, down 15% for the month. They call the banks. PPT gets involved, and the market takes off. And we were down, like I said, 15% in December. Now we're up roughly, call it 13.5%, pretty much in a straight line. So far, year to date, the S&P 500, as you can see right here, is up 6.5%. The best performing sectors or industries so far are the ones that were hit the hardest right over here. So XES, oil, equipment, hit really hard. So far, it's the best performing sector or industry, up 23% year to date. OIH, same thing, oil service name, up 22%. XOP, same thing, up 19%. And the biotechs that were hit really hard as well back in December, up 16% year to date. So far, off this initial push, which is what always happens, what was beaten up the most is up the most. And that's the reason why you have to be able to bring a couple of gloves to the ballpark, because if you're looking to buy stocks and your belief system only tells you that you should only buy stocks near the high, then you missed out on a lot of gains of stocks that were bouncing off 52-week lows, okay? And so far, individual stocks are working, and so far, off of this first initial push, the stocks that have been doing the best have been the ones that are down the most. So here we are with the market down, with the market up 14% in a matter of 2 or 3 weeks, all right? So now most people who were risk averse and took some chips off the table here, okay, waiting for some back and forth action, the market gives you a V-shaped rally, and more than likely, if you sold right over here, you're feeling like you're under invested and the market is not giving you any entries, any decent entries. And what typically happens is that when the market is down here like this, down 8 days and 9 days in a row, you always get that crowd that says oversold becomes more oversold and we're going lower. And those same people, when we get these type of V-shaped rallies, they'll say overbought becomes more overbought and we can remain overbought longer than you can stay rational, blah, blah, blah. It's my opinion that the market goes up and down, not up or down, okay? So I'm not a fan of shorting or selling during these type of situations where people are panicking. And I'm not a huge fan of buying these type of rips without seeing some type of breather or some type of digestion, okay? Which is probably going to happen, okay? We can probably digest here for 5 days and the risk-reward ratio will be much better for the bulls, regardless if we stay at the same price. We want to see some digestion here. That's the bottom line. And just to let you know, back in December, we went from extreme oversold breadth readings right over here. This is stocks above their 40-day moving average. If you go back, it was at a level back on December 24th of 355. Only 3% of stocks are above their 40-day moving average, which was, it was levels that we only saw a few times over the last 20 or so years. We saw it back in 2016. We saw it back in 2011. Just a little bit back in 2011. If we go to the monthly chart, you can see how extreme that reading was, the one that we had back in December. 2000, and this is what, 2001, 1987. So we went from extreme oversold readings to this is not extreme overbought readings, but you can see that here 76% of all stocks are now above their 40-day moving average. As you can see here, you can see that so far when we get to this level, it's been somewhat of a wall, okay? Going back to 2010, 2011, 2012, 2013. And even when we had the extreme oversold readings, it took us a while to get over here. Like for example, back in 2011, we had this extreme reading of roughly a low where we only had 6% of all stocks above their 40-day moving average. It took us 12 to 13 weeks to get back over here. Okay, it's been only 4 weeks. This is extremely quick how we went from oversold to overbought. This is the fastest that I can ever remember this index going from oversold to overbought. So here we are. So like I said, here we are. We're at a level where, you know, more than likely we're going to digest. We'll pull back a little. You know, that's a possibility, and it's probable. You look at the McClellan oscillator, the same thing. You know, we were extremely oversold. This is a weekly chart, extremely oversold over here, negative 256. As you can see here, it doesn't happen too often, and then we go from being oversold to somewhat, you know, overbought. So again, digestion here is a possibility. But the question becomes that, you know, so what do? Do you take entries? If you're a long-term holder and you have some SPY, some IWM, some DIA, some QQQs like I do, then, you know, you always, let me rephrase that. I tend to become a buyer when the market is oversold. Okay, my allocation to the SPY, the Qs, the IWM tends to increase as the market is extremely oversold. The average intra-year decline for the S&P 500 is roughly 14%. So once we get to those levels, I want to increase my allocation to the SPY. Once we get this bounce, I want to you know, reduce some of that fat and trend down that fat. You know, because again, when we go down 15-20%, you normally get a retest. Okay. Whether or not it's going to happen, no one really knows, but it's a possibility. As a swing trader, if you're buying individual common stocks, you know, it's hard to get too aggressive when the market rips like this in a straight line. I've been somewhat conservative with individual names ever since right over here, 109, 110, and we continue to move higher. Okay, so one of the questions that I just got on Twitter was, I'm still finding some decent short-term buy setups, but the market is pretty overbought. Do you keep taking trades in these scenarios, or change the risk management parameters, or just wait? Right, so as swing traders, what we care about, what you should care about, is exactly what you can control. We cannot control what the market does. If it continues to move higher, we can't control that. But we can control what we can buy, where, how many shares, etc. Okay, so you can do a few things. If you believe the market is overbought, then you can just wait and do nothing. Wait for that pullback. It's going to come. Either you get a pullback or you get some type of digestion that just gives you a better risk-reward opportunity on the long side. All right, so you can do that and just wait, sit it out. Okay, the market is not open every day for you to make money. That's number one. Number two, what you can do is you can continue to take the trades. Just reduce the size. You typically take 1,000 shares. If you think we're overbought, just buy 500. If you think we're really overbought, just do 250 shares. You can do that, or you can take it as it is and perhaps maybe reduce your time frame and go from swinging, you know, for 3 to 10 days to maybe just day trading these, you know, some of these things. So you can do that. You can sit out, which is perfectly fine. And if you sit out and you own the SPY, the Qs, the IWM as core holdings, you're not going to feel left out because you still have some type of participation. I think that's important. You want to get rid of the FOMO, own the index, own a piece of it at least. So again, just to reiterate, you can just sit out and wait as a swing trader, wait for that better risk reward opportunity. Number two, you can continue to take the trades just to reduce the size, and you can also reduce your time frame. The other question that I got was, when is the best time to exit a trade? Intraday or end of day? We don't know. No one knows. I mean, it all depends on market phases. If you remember last month, a bulk of the gains came from, buying the close and selling the open. So if you bought something intraday, you lost money. But if you bought something at the close, or if you bought the SPY at the close and sold it at the open, you made money. If you bought it at the open, sold it at the close, you lost money. So it all depends on the market phases. No one really knows until after the fact. So sometimes it's intraday, sometimes it's end of the day. No one really knows. I bet you here, during this little market phase here, I bet you is probably end of the day, because we've been pushing higher every single day. So no one really knows. What you want to do is you want to do a combination, right? So if you have an issue where you don't know, just sell half intraday, sell half at the end of the day. All right, Todd is asking me about, what do you think about the SPY bouncing off the 200-week moving average? It found some sticky support back in 2011 and 2016, and recently bounced again. So here's the purple line, which is the 200-week moving average, right over here, and right over here is what he's talking about. And look, for the most part, it's a self-fulfilling prophecy, in my opinion. I know the boys over at Schaefer Research use the 80-week and the 160-week, which has worked a lot better than the 200-week moving average. As you can see right over here, the 80-week is the green line. Right over here and right over here, it's pretty much the same thing, and right over here. So that, look, there's something to it. A lot of it just self-fulfilling prophecies, whatever the case may be, but there's something to it. But you can see here also with the 160-week, and also they also use the 80-week moving average, which you can see some support right over here, right over here, right over here, and for a little bit right over here. Okay, so sometimes they work. Okay, Bill Peterson is asking me about VICR. Look, it looks good. I mean, for a new entry as a swing trader whose time frame is 3 to 5 days, I probably would not enter the trade here. I would have entered the trade right over here, going through this high of 38.59 on this candle. And if that was the case, my original stop would have been right over here at this low at 35.49. And after this move, I would have moved my stop here to this low of 40.29. Okay. Bill also wants to know about IBM. Right. New money from a swing trader's perspective. My time frame, 3 or 1 to 10 days. I would not put new money into IWM. The stock is up 4 days in a row, and I just don't buy stocks that are up 4 days in a row. Most stocks in the short term go up for 4 to 5 days, and then they go sideways to down and reset all over again. So when I see something up 4 days in a row, I don't care if it's breaking out, some type of resistance level or a high, I'm staying away from it. Okay, so someone's asking me about the FTSE 100. Where are we heading with the FTSE 100? I don't know. I don't follow the FTSE. I just do American markets. Will you be watching the inverse ETFs such as SPXU and SDS in the event of a market pullback to digest? Yes. I will be watching the SPXU and the inverse ETFs. To see if we can play a pullback in the market. I don't know. It's it's going to be hard to play, and the reason why, when you get this type of momentum, it doesn't die that quickly. Okay, it just doesn't happen. I think what's going to happen is that we're going to get a nasty shakeout. By nasty, I mean quick, 3 to 5 days, maybe 3 to 5% pullback, and then we're probably going higher. When you get this type of momentum, I don't think it just doesn't die that easily. So playing the inverse ETFs, if you're looking for a 3% pullback at best case scenario, if you nail the top, you get the top tick, what are you going to get, 9% on the SPXU, on the triple? You know, that's if you nail the top and you nail the bottom. And that's not going to happen. Maybe you get 5%. Is that really worth playing? Maybe, maybe not, depending on how you size it. For the most part, I'd much rather raise my cash levels, wait for that pullback, and then become a buyer. Someone's asking me if you have a way to tell if a tall candle is sold off, shorted, or manipulated by that. No, you have no idea of knowing whether something's being manipulated or a candle by the market makers. You have no idea. Also, if short interest grows, what percent of time do you fold versus hold for a squeeze? Read that over 20% of float short, you're likely toast if long. That is not true. You know, short interest is only a bullish contrarian indicator if the stock is going up. Okay, so then you can say, hey, the shorts might be able to might get squeezed because the stock is going up. That's a contrarian, you know, look. If you have a high short interest, but the stock is moving up. If you have a high short interest and the stock is going down, then the shorts are right, you know, and they're probably not going to get squeezed unless price turns around and starts to move higher. Now, there's no doubt in my mind that, you know, shorts, in my opinion, for the most part, are smarter than longs, but playing the short side is completely different. You can have a stock that's heavily shorted, you know, for months, like Overstock.com, okay? Overstock.com was heavily shorted here. It squeezed the shorts like there was no tomorrow. Stock goes from 80 down to 15. The stock is still heavily shorted. So, you know, shorting is not easy. And sometimes you might have a horrible company, but the stock itself might squeeze higher. And they'll just overrun the shorts. So if you're looking for a heavily shorted name to go long, just make sure the price is going up. That's it. That's a contrarian. That's a solid contrarian signal that the stock is heavily shorted. The stock is in an uptrend. That's good if you want to go long. If you're looking to go long and the stock is heavily shorted, but it's going this way like Overstock, then you don't want to be long that stock just because it's got a high short interest. So to summarize the video, we went from oversold to overbought, okay? Some breadth indicators, like for example, stocks above their 40-day moving average went from extremely oversold levels that we have not seen in years to overbought levels that we have not seen in a long time, okay? And it's making it tough to really get, you know, too aggressive as a swing trader with, you know, with new swing ideas with the market up 13.5% in a matter of, call it 25 days, 16 trading days, okay? It's extremely hard to get aggressive here on the long side with new swings. If you own the indices, you know, that's no problem. Don't take the swings. Just wait for that pullback or wait for the digestion. You're probably not feeling FOMO because you have a piece of the market. If you don't own the SPY, the Qs, or the IWM, you probably have, you know, some type of FOMO, fear of missing out, and you can't stand this market moving up without you. But you're also afraid that if you get too aggressive here, you get a quick shakeout, the market goes down 2 or 3%, you own a bunch of individual stocks, you'll be down 8%. So what you can do is just be patient, do nothing at all, or you can take the signal as they come, because the market doesn't have to pull back. Although the probabilities are high that it's going to pull back or digest, it doesn't have to do it. So you can, you know, be mechanical and also be somewhat discretionary. You can go half and half. So you take the signal, that's your mechanical side. Discretionary is that you reduce the size to a level that's a little bit less than your usual size, so that way you can take into account how overbought the market is. Okay, so trade them well and be well.